An entity shall determine whether a transaction or other event is a business combination by applying the definition in this IFRS, which requires that the assets acquired and liabilities assumed constitutes a business. If the assets acquired are not a business, the reporting entity shall account for the transaction or other event as an asset acquisition. And then they indicate to us that paragraphs B5 to B12 will provide us guidance on identifying a business combination and the definition. Right, now why is this important to us? Because we have a new definition of a business, and this is applicable from 1 January 2020. Therefore, we need to identify if all of the assets and liabilities meet the definition of a business. If our answer is yes, we know that this is a business combination and we may apply IFRS 3, our acquisition method. If our answer is no, we need to identify that this is a normal asset acquisition. Okay, now guys, the definition of a business is included in Appendix A. This is your Appendix A of IFRS 3. My recommendation, you know that this is an important section, this is a new section. Include a flag indicating that this is Section A or Appendix A. And you will identify, I've included an orange flag indicating Section B. Why? Because if I get a theory question, it will be easier for me to open these sections. Okay, now guys, please bear with me. I will have to read through the principles with you, the paragraphs with you, and then I will explain them to you. Now, when we look at the definition of a business, it's an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods or services to customers, generating investment income or generating other income from ordinary activities. Now, this is important, guys. We need to identify that there should be income generated from the process. And then when we look at the definition of a business combination, it's a transaction or other event in which an acquired obtains control of one or more businesses. Therefore, we need to meet the definition of a business. Transactions, sometimes referred to as true mergers or mergers of equals, are also business combinations. And guys, then we know we need to apply our IFRS 3, our acquisition method. Right, now I want you to please open your Appendix B. Appendix B7. Again, guys, bear with me. We need to read through certain of the principles first before I'm able to explain this to you. Right, now when we look at this, a business will include three things. There has to be an input, a process, and an output. Remember your key words here, guys. Input, process, and this together should generate an output. Now, when we look at input, this is any economic resource that creates outputs or has the ability to contribute to the creation of outputs when one or more processes are applied. Examples include non-current assets, including tangible assets or rights to use non-current assets, intellectual property, ability to obtain access to necessary materials or rights, and employees. And then two, guys, the process can be a system, a standard, protocols, anything that will be able to be applied to the input to create an output or has the ability to contribute in creating the output. And then the output will be a result of inputs, processes. Now, guys, this should be income, revenue, any form of income that you will be able to identify. Okay, so if we look at a very basic example, guys, we have a clothing manufacturing entity. Now, this clothing manufacturing entity has the machines, right? We have our manufacturing machines. We have intellectual property in terms of certain clothes that can be manufactured. And the output here, guys, will be the clothes being manufactured, and the entity will receive an income from this. Therefore, our inputs, economic resource, it will be our machines, it will be our IP, and there is a process in terms of developing, guys, to be able to generate and manufacture clothes. Right, the very basic example, guys. Now, optional test to identify the concentration of fair value. Now, this is very new, and guys, bear with me. We're going to work through this. Bear with me. I'm going to read through the things, but we are also going to look at examples. Now, when we look at this, optional test to identify the concentration of fair value. Right, before we look at this, just a reminder, guys, make use of one color for certain keywords. You will identify that this is what I've done. It will help you when you open your textbook to identify the important principles that you need to apply in your theory questions. Right, now when we look at B7A, indicates to us that paragraph B7B sets out an optional test, which they call the concentration test, to permit a simplified assessment of whether an acquired set of activities and assets is not a business. An entity may elect to apply or not apply the test. This is important. Therefore, you will have to please read the information. An entity may make such an election separately for each transaction or other event. The concentration test has the following consequences. Right, now this is important. If the concentration test is met, yes, then this is not a business. Now this is important, and it might be confusing, guys, because normally if we say to something yes, then you think yes, it applies. But now, if the concentration test is met, it is not a business, and this will be normal assets acquired. B, if the concentration test is not met, then it is a business, and we need to apply our principles in IFRS 3. Now, B7B indicates to us what is the concentration test. Okay, now the concentration test is met if substantially all of the fair value of the gross assets acquired is concentrated in a single identifiable asset or a group of similar identifiable assets. Look at this, guys. If we identify here, we are talking about a single identifiable asset or to a group of similar identifiable assets. Okay, now let's first have a look at what is identifiable. Now, this is included in your Appendix A. If you refer to your Appendix A, identifiable at the bottom. An asset is identifiable if either of the following, guys, this is or, is separable, capable of being separated or divided from the entity and sold, transferred, licensed, rented, or exchanged either individually or together with a related contract. Identifiable as all liabilities regardless of whether the entity intends to do so. Therefore, it has to meet the separability criteria. Can this asset or contract be separated from the entity? Is this separate? Can we use this separately from the entity? Or if it arises from contractual or other legal rights, regardless of whether those rights are transferable or separable from the entity, or form other rights and obligations. Now, we are going to look at this, guys, when we touch on our identifiable assets and liability section of our purchase acquisition scenario. Okay. Now, remember, the asset has to be identifiable. Therefore, we need to look at our separability and our contractual criteria. We're back at B7B. When you look at the right side of your screen, if you refer to C, D, E, and F. This will explain to us what is single identifiable assets or a group of similar identifiable assets. But let's just have a look at the concentration test. What does this actually mean? Now, this will be when all of the fair value of our gross assets purchased is concentrated into a single identifiable asset or a group of, now let me just include this, guys, a group of similar identifiable assets. Now, if the fair value of our gross assets purchased is supported, guys, concentrated, consist out of, let me just write this, consist out of single identifiable asset or a group of similar identifiable assets, then our concentration test will be met. If your answer is yes, our concentration test is met, and then this is not a business. This is separate assets. Remember, if you refer to B7A, if our concentration test is met, yes, then this is not a business. Okay, now let's have a look at the principles in determining the concentration test. 7BA, they indicate to us gross assets acquired shall exclude cash and cash equivalents, deferred tax assets, and goodwill resulting from the effects of deferred tax liabilities. Therefore, in determining your gross assets purchased, they indicate to us that this shall exclude cash and cash equivalents. Okay, guys, there is an illustrative example in your illustrative examples textbook. B, the fair value of the gross assets acquired shall include any consideration transferred plus the fair value of any non-controlling interest and the fair value of any previously held interest in excess of the fair value of the net identifiable assets acquired. The fair value of the gross assets acquired may normally be determined as the total obtained by adding the fair value of the consideration transferred plus the fair value of any NCI and the fair value of any previously held interest to the fair value of the liabilities assumed other than deferred tax liabilities, and then excluding the items identified in subparagraph A. However, if the fair value of the gross assets acquired is more than the total, a more precise calculation may sometimes be needed. Right, now let's just stop right there. On the left side of your screen, I've included a very basic example, guys. I just want to explain to you the paragraphs. Now, when you look at the basic example, the first section here relates to the fair value of our net identifiable assets. Remember, if we refer to identifiable, it has to have the separability criteria or a contractual criteria. Right. Number 2 is the fair value of our gross assets acquired. Okay. And then number 3, just the gross assets acquired and excess. And then we have the total in terms of our, look at this, this is the total in terms of the fair value of our gross assets acquired. Right. Okay. Now, when you look at this, in number 2, the fair value of our gross assets acquired will be the concentration paid plus the fair value of our NCI plus the fair value of our remaining interest. And this, in this very basic example, will be 6 million minus our net identifiable assets calculated in number 1 at the top. Do you see that the 4.5 million agrees? And this will result in an excess of 1.5 million. Okay, guys, very similar in terms of our goodwill calculations when you look at this, right? But we now talk about the 1.5 million as an excess. Okay, then in step 3, we have our gross assets acquired. All of these amounts I provide you with now, right? And this is 13.5 million plus the excess. And then this will then be the fair value, the total fair value of our gross assets acquired. Now, when we read through the first section of B7B again, the concentration test is met if substantially all of the fair value of our gross assets acquired, right? This is in our step 3. Do you see, guys? We have determined this in step number 3. The fair value of our gross assets acquired, going to write this down here at the bottom left corner, please, guys, and this is 15 million, is concentrated in a single identifiable asset or group of similar identifiable assets, is concentrated in a single identifiable asset or group of similar identifiable assets. Now, what is that, guys? This will be the 13.5 million of gross assets acquired. This section here, guys, the 13.5 million are gross assets acquired. Therefore, if it is concentrated, do you see majority of the 15 million consists out of our gross assets acquired. Therefore, if we look at this, 13.5 million on 15 million, and this will be 90%. Therefore, 90% of this 15 million consists out of our gross assets acquired. Then our concentration test is met. And this is not a business, but this is assets acquired. Let's look at paragraph C. A single identifiable asset shall include any asset or group of assets that would be recognized and measured. Recognized, remember, your journal measured your calculation, the amount, as a single identifiable asset in a business combination. Therefore, guys, your separability criteria and your contractual criteria. Refer to the definition, please. Single identifiable asset in terms of a business combination. Then D. If a tangible asset is attached to and cannot be physically removed and used separately from another tangible asset. If you think about this, guys, we have a building which is on a piece of land. We cannot remove that building without going through quite a lot of significant costs, right? Then the standard indicates to us that we may identify this as a single identifiable asset. E. When assessing whether assets are similar, an entity shall consider the nature of each of the single identifiable asset and the risks associated with managing and creating outputs. Therefore, your keyword here, guys, is risks that you need to look out for. And what is the type of classes? Okay, then F is very important to us. The following shall not be considered similar assets. Now look at this, guys. This is in terms of our group of identifiable similar assets. Remember, if we refer to similar, we need to look at our risks and the classes. Okay. 1. A tangible asset and an intangible asset. 2. Tangible assets in different classes, for example, inventory, manufacturing equipment, and automobiles, unless they are considered a single identifiable asset, remember, which we have identified in terms of D at the top, guys. the land and building example. 3. Identifiable intangible assets in different classes, for example, brand names, licenses, intangible assets under development. 4. A financial asset and a non-financial asset. Financial assets in different classes such as account receivables and investments in equity instruments. And then identifiable assets that are within the same class of asset but have significantly different risk characteristics. There's our keyword again, guys, the risk characteristics. Therefore, they indicate to us that these type of assets will not be similar assets.